It's been a pretty brutal day in the markets. At the same time, we do have this white-hot IPO market, some big ones coming in the near future. What should IPO investors and indeed companies going public be thinking on a day like today?
Yeah, well, first of all, Ed, thank you for having me, and thank you to Bloomberg for broadcasting from the Goldman Sachs Leveraged Finance Conference in beautiful Southern California.
It is beautiful, definitely.
It certainly is. Let's start with the markets. So the markets, it's been a bumpy couple of days in the markets. And as I've talked to clients about what's going on and what they think about the markets, they're largely focused on whether the president's tweet from Saturday or from Sunday ends up being rhetoric or it ends up being policy. And I think we've seen the impact of the potential for it to be policy in the markets the past couple of days. If it turns out to be rhetoric that gets a better trade deal, then I think the market will snap back. And if it turns out to be policy, I think it'll be bad news for the U.S. and for China and for the markets more broadly. As it relates to the IPO, it's interesting. The IPO market has really been the story of the second quarter, and I think for the rest of the year. It's quite exciting, the number of companies that have gone public and the number of companies that are in the pipeline. I think most investors that are looking at these companies are investing for the long term. So they're not going to be overly impacted by a couple of days in the market. But we have seen an incredible wave of companies become public. There's been lots of focus on these high technology, high growth companies. But if you look at the companies that we've seen to date, you've seen a 165-year-old company in Levi's, and you've seen a 10-year-old company in Beyond Meat. So it's been a pretty wide range.
The best performer has been, as you say, like a false or faux meat producer. Why do we see that divergence in sort of, as you say, these are long-term investments for a lot of people, but that sort of day one or week one fortunes of some of these companies? Why are some doing so well and some less well?
Yeah, I think these transactions are quite complicated to execute. I think in particular, this wave of companies that's coming, you need to help explain to investors new business models that they haven't really seen before or haven't invested in as public companies. And then you have to decide how they're going to value these companies and the balance between growth, which is getting lots of value right now, path to profitability, and market share. And so that's one complicated element of pricing these things the right way. And then the other is exactly what the issuer's objectives are. Are companies trying to maximize the price at which they can raise proceeds? Are they trying to build an investor base for a long period of time? And then the final variable is you've got a wide range of proceeds being offered. So companies with a couple of $100 million afloat versus billions of dollars afloat are going to have very different supply-demand impact in terms of the market, the pricing, and the immediate aftermath of trading.
And obviously, we are here at the Leveraged Finance Conference, a lot of middle market clients in this conference with us. That's been a part of the market that has suffered this year. Candidly, since December, when we had that volatility, we've seen a real pullback in particularly middle market M&A. At the same time, it's been an area Goldman has pushed very hard into. A lot of fanfare around you sort of putting more bodies on the ground across the country, building these relationships. Are you there for the long term now that this opportunity seems to be, as I say, coming in a bit?
Yeah, we are. I mean, as you know, we've got David Solomon took over as CEO about 6 months ago, and he's been challenging all of us running businesses to figure out how to grow the business and how to deliver better returns for shareholders. As we think about growth in investment banking, there's really three ways we can grow. We can increase our market share for the clients and products we offer today. We can add new clients, or we can add new products. This push into the middle market is really around trying to add more clients and be Goldman Sachs serving more clients. And again, our definition of middle market is $500 million to $2 billion. And these are substantive, substantial companies. And candidly, today it already makes up about a quarter of the companies we're covering. So it's just covering more companies in this segment and delivering the kind of Goldman Sachs quality, service, and execution we can to this client base, which is a pretty big opportunity for us to grow our share.
And how do you do that? Because that's of interest to me. If I'm someone wanting to come in and work at Goldman Sachs, I guess it's because I get to work on these major deals. It's because I get these sort of headline clients and high-profile, high-visibility situations that I'm involved in. How do you attract people to come in and, as it were, sort of pound the pavement between New England and San Francisco?
Yeah, it's interesting. So I'd say, in my perspective may be different. I think people come to Goldman Sachs to work in a world-class organization and to learn in an apprenticeship culture from people who've done it for a number of years, and to be able to serve clients and work on interesting transactions regardless of necessarily the size of the company or the geographic location of those clients.
And more generally, the M&A market has been booming this year. We've seen some very big transactions. You guys in the middle of one of the more interesting ones at the moment in the form of Occidental, Anadarko, Chevron potentially still there. What is fueling this sort of extreme confidence in the market, where we're seeing overbids, where we're seeing shareholders step up and actually be vocally opposed to deals? It just seems that there's a very high level of belief at the moment in M&A.
Yeah, as you said before, we've seen a drop-off in M&A at the smaller scale, but the big cap transactions have continued to happen. And I think what's been really interesting is you've seen activity levels in sectors that haven't really seen it. So you've seen bank consolidation in financial institutions. We haven't seen that for a number of years. You've seen a lot of activity in energy, and I think more to come. And I think companies are feeling reasonably good about their current positions, and those sectors which had been under further pressure in the past handful of years when we saw lots of M&A activity are now starting to feel stabilized and in a much better position to think about consolidation and think about growth via M&A.
Do you think we are, I mean, we've been saying this for years now, but do you think we're sort of late cycle, and that's one of the reasons we're seeing this wave of big consolidation? Because I guess if you don't do it now, the window may close.
Yeah, well, I think we're definitely late cycle, although, as you said, we've been saying that for years, and it feels like we could continue to be late cycle.
And it feels like we may have gone back in time from a year ago when we were saying we were late cycle, because it seems slightly better as an M&A market.
Yeah, no, it's fascinating. You had a shot in the arm in the U.S. economy with the tax cuts last year, so that was a little bit of wind at the backs. You saw a wobble in the overall equity markets in the fourth quarter last year, but the first quarter of 2019 was the best performing equity market in 10 years. And so that's performing well. Credit markets are performing well. Transaction volumes are high. And so there's always the risk of exogenous events, and whether it's a trade war or it's Brexit or it's Fed policy, there's anxiety out there that gives caution. But in general, companies and boards and CEOs are feeling reasonably good about the outlook, and I think that's likely to continue to drive activity.
Okay, so let's talk about an exogenous event that has obviously been in the news much recently, which is the 1MDB scandal, heavily involved with Goldman. How has that affected the bank's ability to do business in Asia?
Yeah, thankfully, very little. And so outside of some specific transactions in Malaysia, where it's a pending issue, and some specific companies that were around that original transaction, it's had very little impact on our business. And we've had our people just be out there focused with clients and serving clients. We've focused in particular in Asia, where our market share has never been higher. I mean, I think, as you're aware, 9 of the top 10 TMT equity deals last year came out of Asia, and we did 7 of them. So it really has had little impact on our franchise, but we need to be vigilant and make sure we continue to serve our clients.
So I want to ask about that vigilance. If it's had little impact, that would suggest that, one reaction to that would be, well, we don't need to change anything. Everything is still good there. Is that the case? And if it's not the case, what does Goldman need to change in Asia?
Well, I think there's lots of self-reflection on how we could have an employee like this at our firm who ended up going out and committing crimes. And it's painful for us to look at that. And so we need to continue to go back and robustly look at all of our practices and policies and do what we can to improve them.